A lot of people would say that there's a bit of an undersupply, and especially an undersupply of more of the quality of campgrounds that people are now looking for.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, excited to have Dylan Marma. Dylan, how are you doing today?
I'm doing great, Todd. It's great to see you.
Yeah, man. It's been a long time. We said that before we jumped on here or before we hit the record button, but it's been a long time. Excited to see you just really and hear about really what you're up to. You've done a lot of cool things since we last got to see each other. And so want to dive in. So a little bit about Dylan. He's the principal of you. Man, you fooled me because I would have said it perfectly, but now I'm going to say it wrong. But Requity Group, a vertically integrated real estate private equity company, and he's been investing full time for the last 5 years. Been a lead sponsor of over $150 million in transactions, including over 750 multifamily apartments, 2,000 lots of manufactured housing communities and RV campgrounds. And I really want to dive into some of that stuff. Dylan's a firm believer that through careful deal selection, attracting exceptional people, and utilizing technology-backed systems, you can ensure above average risk-adjusted returns through real estate. And man, I would completely agree with that. So Dylan, with that said, man, why don't you just give our listeners a bit more about your background? Then I want to dive into some of the fun stuff.
Yeah, sure thing. So I'll just give you kind of the high level. But yeah, started off a little bit over 5 years ago after studying avidly the world of multifamily syndication. I took a big leap of faith, left my W-2. I had a couple single family home rentals through turnkey rental company and enough cash to help me partner my way into a 21 unit multifamily building. And then from there on, was fortunate to link up with some partners in the Southeast that had existing experience, but were raised outside investor capital. So moved out to Tennessee, partnered for 3 years in the multifamily space, and worked on, like you said, about 750, 800 doors or so, and really kind of cut my teeth there in the multifamily space and learned a lot about the real estate business as a whole, and the operation side of the business as we were self-managing. My partner was leading the property management side of the business. And then a little bit over 2 years ago, actually about the week before COVID hit, we decided to go in a different direction just because we had different long-term goals at that time. And I really saw a lot of opportunity in the mobile home park space at that time. And it just didn't make sense to me that these mobile home communities were trading at 7 caps or 8 caps when you were seeing 5 and 6 caps in the traditional multifamily space. And as you dig in and kind of look further into it, the actual risk on traditional mobile home communities, I view as very comparable. And in some ways, some would argue it's less risky than traditional multifamily. So I saw a little bit of a gap there. So this is like a great place to start the new company. And we started Requity, started buying mobile home communities. And we early on started to see that thesis play out and started to see the cap rate compression take shape. And while we were starting to build our portfolio of mobile home communities, we started to also, a lot of the same brokers in this space also happen to broker RV campgrounds. So we started to see more and more of these RV campgrounds. We initially purchased a half mobile home community, half RV campground. And then we ended up finding our first sort of pure play RV campground that was 140-ish sites, and it was all long-term, what we call seasonal sites, where they pay for the year, they have year-long leases. And we said, well, this looks simple enough to, and similar enough to what it is that we're doing. So we jumped into it, and then sure enough, we started to fall in love with the space, started to understand all of the nuances that come along with the campgrounds, and started to just learn up on the space, and then pursue different types of RV campgrounds throughout the Southeast, both consisting of your seasonal campgrounds, or campgrounds that are full of what we call your annual site agreements, as well as campgrounds that have more of a short-term or a transient component to it. And that's really been the majority of our activity in the last year or so. Is last year and a half really has been a lot of campgrounds, and it's been great business to us so far.
Which do you prefer, the long term or short term, or do you like to see a campground that has a good mix of both long term or short term? Is there a better answer to that?
Yeah, so I don't think there's a right or wrong answer, but I think every investor has their preference. When I initially got in, I said, well, I love sort of that sticky, long-term, consistent revenue. And
Yeah.
Look at the two big REITs, it's Sun Communities and then ELS, which is Sam Zell's company. And ELS tends to lean a lot more on their annual site agreements and has a lot more long-term, whereas Sun Communities is more focused on driving NOI to be the absolute highest it can be, right? And both of them do exceptionally well. But I would say that we've leaned more into modeling after what ELS does, with more of these long-term site agreements, buying majority of our portfolios along the coast. And we like the campgrounds that sort of serve as a second home, so to speak, or almost like an affordable version of a lake house or an ocean house, right? Where someone can keep their RV there year round and go every weekend that they want to, and go and have fun and build a community and make friends with everyone else in the campground, and have this be their place where they can effectively treat it like an ocean house, and then they don't have to deal with the taxes and the insurance and everything else that comes along with having a house on the near the water. So that's really better than bread and butter. But as a portfolio, we really target more of like a 70-30. That's we like 70% long-term annual site agreements and 30% more of the short-term transient to help increase our exposure and maximize our revenue.
I suppose, just thinking about it, your long term is going to be probably less potential upside in the NOI, but a lot more stable. Where your short term, you're getting higher rates, probably a lot higher risk, because you've got the vacancy risk, you've got just people that are in and out. So probably more damage risk, probably more maintenance risk. Is that
Yeah, that's
accurate?
definitely accurate. Yeah, I would say that on a long term, just trying to do some quick math here, but I would say that your income might be 50%, probably somewhere between 30 to 50% less per site per year over the course of the year. But then you're also able to run it on a little bit of a lower expense ratio, especially if the majority of the community is long-term. You don't need quite as much, front desk staff that's
Staffing,
helping with
right?
all the check-ins and check-outs, and you don't need to hold quite as many events. So your expenses do go down as well with the long-term model. So.
Yeah, that makes sense. I mean, you've got a lot of check-in, check-out, so you have to have more staff there, and that's an expense. And yeah, so I didn't think about that expense, but definitely. What is attractive? Like, what do you look for when you're looking for an RV park? What, like, if you're saying, hey, we like this deal, why did you like that one versus a different one? Are there like key elements that you truly look for?
So the first thing we look for is protecting our downside. I think that's the most important piece within the campground. Is not you can make, this is the tricky part about this space, is you can make any single campground look nice on a spreadsheet, even more so than you can in, say, apartments, because apartments, at least you have CoStar and you have pretty predictable levels of rent, and you sort of can know the area's average occupancy. Whereas in this case, usually the best data you have might be some competitors' properties, P&Ls that you've seen over time, and you sort of aggregated your own internal database to help you see what's possible. So for us, the first thing is trying to really get a good sense of the in-place financials and the area's overall level of demand. A lot of the industry likes to say be within 2 hours of a major city. We like to be more within 1 hour, or actually within a major MSA, because we feel like your risk, if you're 2 hours away from a big city, is that your risk there is that people could build closer to the city and they could build nicer stuff, and then you start to become sort of obsolete. and don't have as much of a purpose as you maybe once did. So the first thing is, finding a good location. In our case, we like to be inside of 200K plus MSAs, and we like to be within an hour, or less drive from major cities that we can draw from. And we also like to underwrite the deals in a way where even if we are running it, or if it's currently running with some short-term stay income, that we can protect our downside by pivoting to more of a long-term strategy and still being able to service our debt, and in sort of a doomsday scenario, maybe being able to afford, move in people that want to be there for more of a long-term stay than they do for as much recreational purposes. So
Yep.
I think for us, just looking at it, we said that that's a good way to protect our downside, is just being able to put some good parameters around the location itself and buying the right markets, and then forward looking in terms of how we create value. There are a number of ways, but we love to find the communities that maybe just haven't. What oftentimes happens is that sort of a mom and pop owner start these businesses. They started 30 to 50 years ago. It was their absolute life for the first 20 to 30 years, and then eventually they start to get tired of running it and they start getting ready for retirement.
Yeah.
And they don't have a website, or the website looks like it was built 20 years ago. There's no money going into any Google ad spend. All of the CapEx is, there's a ton of deferred maintenance because they've been going out and spending all of the money versus putting it back into the property. So this really poses itself as easy upside, where we can create a good online presence, create a good website, put money into Google ads, Facebook ads, be able to invest into all the deferred maintenance projects, be able to help bring the rates up to market, and being able to run events. That's usually a huge part of this business too, is doing events. During the main season, we have campgrounds that do events every single weekend, to be able to kind of give people a reason to come out and reason to gather and to kind of form a tight community. And that tends to be sort of the bread and butter, is finding campgrounds that really can use, just like you would with any asset, is finding like the value add component to it. That's really our bread and butter. So finding the right market and then finding something that's got enough upside on it to make sense of.
Are you buying a lot from these mom paws? There's still that I know a couple. Like we were talking before the show, most of the campgrounds around us are smaller that are private, but even so, a lot of the owners live there.
Mm-hmm.
Like I know quite a few that have a small house there, or the owners just live in a camper there, and they've been there.
Oh yeah, that's probably, I want to say 40% of the purchases we've bought, that was the case, where they're living on site, and we're usually giving them a 30-day window after close to help get all their stuff off the property and move out.
Do you ever keep them there for continued support and management?
No, and I don't, we've worked with some phenomenal owners, so this is not a blanket statement, but we definitely would never allow them to stay there, because we've faced our issues where people, they love the campground, they feel connected, they how entrepreneurs are, is they feel like things should be done their way, and then they see changes getting made, and it drives them nuts. So
right. You're trying to change too much, and they're going to get pissed off. And
we'll keep the staff for sure. Like the staff themselves, we always try to keep, because they're going to teach us so much about the properties. But when it comes to the owners, they tend to be so involved, and they get their emotions so tied up in the place that I probably wouldn't do it.
I can see that. How about like amenities? Are there specific things you have to have on these campgrounds to want to move forward, or at least be able to add?
Yeah, for sure. So I think the point I brought up earlier about not becoming obsolete is important. And I think that there's only really a handful of other, what I consider to be like kind of the middle market private owner operators, like in our space, that are sort of slowly consolidating some of the industry. But I think that something that's important to all of us is to find ways to stay relevant and stay in the, to be attractive to the modern day camper. And some of the basics are, one, I'm not a huge believer that partial hookup sites will be very popular in the future. So definitely having a full hookup site, meaning that you have water, sewer, and electric. Partial hookup is usually just water and electric, but we generally like to have longer term stays as well. And I think people are just getting so used to the convenience of having sewer on site. So we don't want to have partial hookup sites. So we're generally looking to convert the partial hookup sites into full hookup sites and have both 30 and 50 amp electric, because a lot of the newer campers need 50 amp electric. A lot of old campgrounds were built with 30 amp electric pedestals. And in addition to that, we need a laundry room, because the little, all-in-one laundry units in the RVs are just not great, and everyone likes, yeah. So everyone wants to go out and have a good solid washer dryer that they can use. So we usually have just coin operator or now card operated washer dryers. Having a bathhouse, because for similar reasons, if you have multiple people in an RV, they're all cooped up in this small bathroom, that just is not ideal for everyone. So having generally bathhouses on site is an absolute necessity. If there's not one, we always will make sure we're adding both a laundry room and a bathhouse. Those are more of like the necessities. And you have the bark parks, which are becoming closer to necessity. And then from there, it's upgrading sites. Do you pave the roads? That can be a huge value add. Adding concrete sites, adding what they call rearranging the sites to have buddy sites where two people can book a stay together and face each other during the middle of the day. We usually end up doing renovation to the clubhouse and the campground stores. In some, we are currently adding pools, and then we have blow up slides. We have actually like a blow up axe throwing on one. We have pedal carts. We have golf course, mini golf courses. Those are pretty popular. Kayak rentals, boat rentals. One of them actually had a petting zoo on it. And
did you keep it?
We currently we've scaled it down, is what I'll say.
It seems expensive to maintain a petting
yes,
zoo.
Exactly.
Animals aren't cheap to keep alive.
Yeah, exactly. So there's kind of a liability, and then maintenance. So we have like little gold rush things where kids can mine for gold on there. So a lot of it, as you see, kind of a trend is like it's family oriented stuff. A lot of the time trying to find stuff that the kids can do, and kind of keep it focused on families, as that generally is what is going to keep kind of drawing people out there. But yeah, just to the point of, again, being like relevant in today's day and age too, it's just a lot of these things were just built with smaller sites back when people had smaller campers. And there is a lot of work that goes into just making it fit today's standards that people have.
What are the red flags to look for when you're looking at, either these, or, we haven't talked mobile home park really, but you also do mobile homes. So either, the RV campgrounds, mobile home parks, what are some red flags that you're really looking out for?
Yeah, sure thing. So since we've been mainly talking RV, I'll start there and then I'll hit on traditional MH. But on the RV side, I think the biggest mistake that I see people make is focusing too much on painting sort of the rosy upside without true concrete data to back their this on deals. So I think that's
probably the danger with all asset classes,
yeah,
right?
Yeah,
is trying to assume you can do too much, right?
Yeah, exactly. Well, exactly. But you usually, at least with other stuff, you generally can get more data. Whereas in this case, like you can easily just tweak it from 40% occupancy to 50% occupancy, and that looks great, right? But so I think the dangers are weak locations. That's the number one that freaks me out the most, and is the number one thing we try to stay away from, is being too tertiary to where you just might not become sort of relevant in the future.
So is that the weak location? By weak location, is that the within an hour of the city? You also mentioned you like to buy stuff on the coast. Are you talking like on the coast?
Some
like
of ours are on
access?
the intercoastal, and then some of them are more like within 10 to 15-minute drive from the
so short drive where somebody could get there. You have to have a destination, right? You have to have a reason to go. Is that kind of the
You have to either have a destination or be the destination. So, if you like a lot of these resorts going up in Florida right now are just, amazing, but they are the destination. So they have on-site food and beverage, and they have enough amenities and entertainment to keep people there all day long, and they can do really well. But if you're buying, say, a smaller campground, when I say smaller, probably anything under 200 sites, you probably need to be at a destination that's going to drive them there, because you're just not big enough to make yourself into the destination. So yeah, we have 2 in the Smoky Mountains. A lot of ours are along the coast. We love being on big lakes or bodies of water. A lot of our people are big boaters, and that's the main reason they drive out there. So they have their toys, their RV and their boat kind of working side by side. Some of ours are near, one near a zoo, one near another major attraction. And, so yeah, I definitely think being in a location where there's a draw, but also being in a location where there's not just one draw that is your exclusive reason for being there, because that also can be detrimental too, right? So.
Yeah, that makes sense.
And then on, outside of that, I would say that private utilities, we deal with a lot of that, because generally the land that these places are built in, they just don't have public access to utilities. So you deal with a lot more private utilities. Otherwise, there'd probably be subdivisions built there. So you have to make sure you're getting the proper inspections done on your utilities. I'm not one to say there's no private utilities, because I think in this space, you sort of have to be somewhat open to it in order to, get meaningful level of deal flow. But you have to be sure to protect your downside and get the right inspections and buffer, right kind of contingencies. So understanding the private.
And as long as you're budgeting for, my house, I have private well and septic. And as long as you're budgeting for that, or you can handle that big bill when it does come, because it won't, it's not going to come every year, but it's going to come eventually. And you're going to have to rework the septic, and you're going to have to replace, some, well pumps and things like that. But otherwise, it's pretty much free to run too. I guess you got the electric for the well pump, but it's very cheap and affordable to run. So it's not going to cost you any more money, but it just sneaks up on people. I think that's the
it could even be less money in some cases, just depending on how much it needs. Yeah, a lot of times it is. The treatment plants are pretty common on the RVs, because to have max density, a lot of times they end up putting a treatment plant in instead of septic. I personally would take septic over treatment plant, because I think there's less of the sort of catastrophic risk, and it's more spread out across over time. But the treatment plants can be, 500 up. We've seen them up to like $1 million for, treatment plant. And, you usually need a third-party operator that needs to have a certain license to run it and operate it. So those are probably the trickier ones to get really comfortable with. And we have, 3 in our portfolio, and in an overall, have, gotten comfortable. At least we've learned a lot more about them and been able to get, relatively comfortable with the ones that we have. But it is, you have third-party operator risk on those, and, it's hard to find other operators. And then if something goes wrong, it can be, definitely challenging to deal with the companies. So,
yeah. Anything else that we missed, or that you want to hit on? I'm sure there's little things, right? But anything else big that you missed?
No, I think that's the bulk of it. Yep.
Okay. Sounds good. Now, you've mentioned mobile homes. Anything there?
Yeah. So on the MH side, the mobile home side, I would say that the bigger flags are one. It's just competitive right now. So you really have to realize, you have to be thoughtful on, your time to get to market rent. I think that's the issue, is that a lot of people say, well, they own the home, which is the beautiful part. Is a lot of times you buy a tenant home community, they own the home and they have this sort of vested interest, and it's expensive to move. But I think, just given how competitive the market's gotten, like, you have to be sort of conservative on the time it takes for you to get to market rent, because a lot of your tenant base are either, fixed income or Social Security. And, I think in order to, one, do right by your residents, and then two, to make it a smoother transition, just giving yourself sort of time to get it up to market rent. You also do run private utility risk. I think the infill plays can be dangerous if you're in the wrong location. Infill is when you have a vacant lot and you're bringing a home in to then sell the home off. if you have too low, even if infill or not, if you have too low of a median home price for that county that you're purchasing in or the city you're purchasing in,
Sure.
then it doesn't really make sense. You know, why would someone go and buy a mobile home for 60,000 new when they could buy a single family home for the same price in certain areas, right? So making sure you're in a good location for that. And then, you know, I think making sure you're budgeting enough. If you have park owned homes, we do a lot of park owned homes. I think it's because I started out in multifamily. We were pretty comfortable buying a lot of the ones where we own a lot of the homes, and then over time we usually sell them off. But they are more fragile than traditional apartments, and they do require, you know, a lot of work to be able to get them into, you know, pristine shape to be able to sell or to rent out. So I think just making sure you budget conservatively on the work that goes into this.
That makes sense. So why as an investor, or maybe you even as an owner, what's the attractive part? Like sell me on why I should invest in an RV park, um, or even a mobile home park. Like
Sure.
what would make it
So
attractive?
So a lot of this comes down to, you know, we always talk about the risk adjusted returns, right? And just making sure, you know, we're comfortable with the overall returns and feel like they're competitive versus what else is out there. And I'll start with mobile home just because I think that's a little bit more well known. So probably not spend as much time there, but with mobile homes, what's attractive is that a lot of times the resident owns their home, and if they don't, you probably over time will sell them that home. And then
Do you do
generally
that on
when
like a rent to own?
either rent to own or third party, we have third party financing options available now too. So once someone owns the home, they generally will stay in the community for 15 to 20 years. So traditional multifamily, you have people moving out every 2 years,
Yeah.
whereas in MH, it's 15 to 20 years. So you have a really, really sticky resident base. And the cost, though you are dealing with a generally lower income tenant base, the difference is that the all-in lot rent generally is, you know, $500 or less, or, you know, sometimes it's a little bit more depending on the location.
Yeah.
But it's such a small amount, and they already own their home, so they have this pride of ownership, and it would cost thousands of dollars to go move the home. So they're really invested in this community more than they would be if they were just a traditional apartment renter. So you have someone that's invested in the community, invested in taking care of their home, and they're highly incentivized to be able to, you know, pay their rent and stay a part of that. And it's usually the rent is half of what it is in a traditional apartment. So it ends up being, you know, collections tend to be similar to, you know, I don't know, somewhere 96 to 98% collections throughout the year. And so it's a really steady, and then you have no capex, or not no capex, but you have less capex than you would if you owned all of the homes or you owned a big building, you know, and that eats up. And multifamily, everyone likes to, you know, underwrite 250 to 450 or somewhere around those per year. But if you held it forever, I'd venture to guess it's multiples of that. You know,
Lots more. Yeah.
yeah. So I think that, go ahead.
If somebody doesn't pay a mobile home park, you know, they're not paying their rent, you know, obviously with rentals, with the rental, you just evict them and they're out, and, you know, depending on your state, municipality, you know, that kind of stuff, they're out within, you know, usually 30 days or less, but of course depends on where you're at. If you're in California or Chicago or something like that, it might be a lot more, but for the most part, you know, 30 days or less. Now, is that similar? Is it eviction, or is it a foreclosure? Like what?
So
What's the
I would say
process there?
our operations staff is going to have a better answer than I would
Sure.
in terms of the state by state dynamics. But you know, our preference is sort of a cash for keys scenario where we can buy their home off them if they're struggling, to then go and resell it, because we don't have to deal with, if they just abandon it, then you have to go through sort of a title process to be able to regain access to the home, and that can be like several months of downtime, which can be challenging. But yeah, that's sort of the high level overview, but it does vary quite a bit based on the county and the state that you're operating in.
Yeah, that makes sense.
And then going back to the RV question on why would you invest into RV campgrounds? The industry itself has seen, on average, pre-COVID, it was around 6% year over year compounded annual growth rate, and it was I think it was about double that during when COVID hit. So I think it was like 8% or something average from like 2012 up till I think it was 2022. So the industry itself has seen a huge level of growth. Similar to our discussion prior to jumping on here, you know, a lot of people were used to thinking of campgrounds as sort of either like tent camping or state parks, and everyone's appetite has just changed. I mean, it's similar to how people spend money on their dogs in ways that they used to never spend money on their, you know, their pets. And, you know, camping is similar in the sense that instead of roughing it in the woods like people used to do sort of growing up, like now everyone has this sort of appetite for glamping and different level of experience when they're going on vacation. So I think now for the first time, really the average camper has a household income over 100,000. So that I think has changed a little bit. It's not really just an affordable vacation option anymore. And two, they're looking for you know, more experiential opportunities, and they want things, you know, I always like to say, like, the younger crowd is liking things sort of done for them, and the millennials are one of the leaders in driving camping right now. Everyone thought it'd be the baby boomers, but millennials have really been leading the pack, and, you know, they want things more done for them, and they want more of like glamping experience. They want more on-site activities, and I think that that has really driven the industry. And then you look at it and you have, I think it's about, I've heard anywhere between 9.5 to 11 million total households in the US that own RVs. And there's about just under a million or so private campsites throughout the country. And, you know, if you look at a lot of, even if you want to get a sample size, if you're not already a camper and you want to get a sample size on sort of what RVers are seeing today, you can go on YouTube and find tons of vlogs to kind of see what people think and what they like about campgrounds and their appetite, and sort of learning the market, as I did a whole lot of early on. And you can see there's a common complaint about there not being enough good sites available anymore. And, you know, people used to be able to go on a spontaneous weekend. They used to say, it's Friday, let's go camping down, you know, at the local campground, but now they have to book months in advance. So I think a lot of people would say that there's a bit of an undersupply, and especially an undersupply of more of the quality of campgrounds that people are now looking for.
Sure.
So you're starting to see a lot of these like resorts and, you know, these campgrounds that you just never would have seen 10 years ago come up.
Yeah, all really fascinating. I mean, you're right. And these little private campsites are kind of fun. I mean, we are traditional, or I am traditional, but maybe not my wife and kids would like probably more of that, the experience of the campground. But I'm like the tent camper, you know, type of guy. I want my private site. But we went to, it was 2 summers ago. You know, the state park was all full, and there was a private campsite really close by. And so that's where we stayed. We were able to get a site there. But man, it was a blast. Of course, they had the pool, and they had a lake, and they had all the blow up stuff in the lake, and bounce houses, and you climb up to the top and do backflips off it and whatever else you wanted to do. And it was just a lot of fun. They had tractor rides and stuff like that. And I think it was only like 100 or so sites, but it was a really cool experience to have. And that's typically not my style of camping, but after doing that, I was like, that was really fun. I can see why people are really attracted to these campgrounds. So, really cool. Fascinating. You're the first person I've had on this show, and I've got, man, I mean, we're approaching 600 episodes. You're the first person I've had on this show that has talked RV parks. So that's great. That's really cool. How about the cash flow? Is this like a cash flow business? Is there a lot of equity upside? What's the main play? Is it
let's definitely talk returns. I mean, one of the big draws for our investors is the tax benefits. Tax benefits generally tend to be significant compared to traditional. I always compare back to multi just because I started there, so it's easy as a frame of reference. But you know, it definitely tends to be with the depreciation. We've seen for every dollar invested, over a dollar loss, using about somewhere, you know, probably 65% average leverage all in, somewhere in that range. So we've gotten, just like mobile home communities, they have just a little bit of a faster depreciation schedule once you get the cost seg done, to where you get a pretty nice loss during that first year. Obviously, things are changing with the step down of the bonus depreciation right now, but that's been a huge driver for our investors. And then when we talk about the cash flows, generally our cash flows, it really varies based on whether it's long-term or short-term. I like to think that on a long-term campground, you may average closer to, we definitely want to be at 10% or greater by year 3 on a long-term campground. But maybe we're averaging somewhere in like that 9.5 range over like a 5-year period, I would say, for something that's got more annual site agreements, because that is a little bit more stable revenue.
Sure.
Whereas on something that has more of a short-term component, we're probably trying to get by year 3 closer to that. If it was all short-term, we'd probably be looking at like a 15% cash on cash by year 3, and then definitely averaging well above 10%. Probably underwriting, we like to, for the technical people out there, we probably want to get up to like a 12% unlevered yield on cash for, you know, something that's got short term, maybe 11% for something that's got long term, and then exit, you know, can be anywhere between say like a 7 to like an 8.5, maybe 9 if it was a softer location, just and depending on the makeup of the place. But that's kind of rough numbers. That's kind of what we're talking about on that side. And then on like the IRR side, usually we like to say, like, for the investors, like high teens is like we like to set the benchmark, and we like to always have, I think there's always like chance we can overperform with you know, having a market.
And are you doing 5-year projections? Is that kind of the
typical 5-year goal? Yep.
Okay.
We generally like to be longer term, like we like to look at refinancing and holding past that point, but we always just do a 5-year projection.
How do you finance them?
Banks. We've taken a lot of, we've done a lot of recourse debt with national banks that specialize in the asset class, but there are non-recourse options, especially as you grow a portfolio. You can look at CMBS or life insurance companies, and there are also like a few recent specialized non-recourse debt funds that I've seen come up. But it's a lot of, for us right now, it's a lot of national banks that specialize in the asset class, and then also we will shop local banks as well.
Interesting, man. Fascinating. Love it. What's a mistake that you've made, you know, in the business, in whatever aspect, whatever you want to cover? What's a mistake that you've made, and how can our listeners learn from it?
Yeah. So on early mobile home deals, I brought up the point of underfunding your capital expense. You know, thankfully we've made it through the thick of it on, you know, the bulk of these situations, but on a few of the earlier mobile home deals, I think I was thinking of them more like similar to apartment costs on how much we budget to do our rehabs before we sell them off, and realize pretty quickly that you know, they're more susceptible to water damage. There's just not as sturdy of materials as a lot of, you know, more traditional apartments. So we ended up just going over on a lot of those initial budgets, and you know, that's frustrating, painful, and, you know, definitely have now buffer like a lot more than I did on some of those early deals. And I think on the RV side, we have probably just we bought a lot of smaller campgrounds, more around like the 100 site level, and I think that I mean, it's been helpful to get us started, but I probably would have went to like the 200 plus site level quicker, as you realize that, you know, when you have 1 or 2 people on staff, it can, you're putting a lot of weight on, well, it's usually at least 2, but then you have some part-time staff too. But when you have a smaller team on these campgrounds, which they can only afford so much of a team on that size, you do start to, you're kind of at risk if someone leaves, then, you know, what are you going to do? You're going to have a regional fly out and fill in, or, you know, it kind of leaves you more vulnerable. Whereas on the larger campgrounds, if you have, you know, 4+ full-time people, like you have a team there, so you're not really as susceptible to damage if someone leaves or takes off. And it's actually easier to operate the larger ones, whereas the smaller ones, I think, can be a little bit trickier at times. So it probably would have went larger sooner on those. And then, just knowing that, just knowing that that's where, there's a reason that the institutions are mostly gearing for that size.
Interesting. Yeah. I mean, it's like apartments, right? It's like probably any commercial asset. The bigger you scale that, the more efficient it is. It's just how it is.
Better exit, more efficient,
Yeah,
better
better
debt.
exit too. Yeah, definitely. Love it. No, man, this has been great. Let's pivot a little bit. What's a favorite book you can recommend to our listeners?
So my go-to is usually Principles by Ray Dalio. Just a big fan of
Love it.
that book and the way that he helps you think about, your life and your business as coming down to a bunch of decisions, that you can have principles that help you guide those decisions and, lead to better outcomes. So,
How do you like to give back?
right now, I think I give back mostly through just helping either the people around me, or mainly just, I think about this industry, just, a lot of my friends, like I'm always happy to pour in, offer advice, offer help and support to, those around me. I think that's my primary form of giving back at this stage of my life.
Love it. That's always valuable. Last question. What are your 3 pillars of wealth creation?
So my 3 pillars of wealth creation, I would say number 1 is education and just building a solid foundation for yourself. And then 2 is having more of a seek to serve mentality, to be able to just put yourself in a position to learn and grow and add value to those around you. And then 3, eventually, after getting educated, seeking to serve and, adding value to people around you, eventually that comes into, the wealth realization phase, which is, where you're able to build, build your vehicle and help you continue to grow. So my philosophical 3.
Dylan, this has been great. Really appreciate it. I've loved talking RVs. It's just fascinating that like I said, I've never talked to somebody that owns campgrounds before, and it's super cool. And camping is like a big part of my life, so I just love like talking about this. It's been a lot of fun. I'm sure our listeners have gotten a ton out of it. It's a cool niche, and I love what you're doing with it. And definitely appreciate you coming on the show, adding a ton of value. So with that said, how can our listeners get in touch with you, learn more about what you're doing?
Yeah, thanks a lot. It was great to be on the show. And as far as following along with us, definitely add me on LinkedIn. It's probably the one social media platform I stay active on. And also you can follow us through the requitygroup.com. And we have a show called Requity Insights as well, which is both the YouTube show and podcast that we tend to teach on.
Awesome. We'll put that in the show notes. Appreciate it again. And you have a fantastic rest of the day.
Awesome. All right. Thanks a lot, Todd.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out. And we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.